Good afternoon, my fellow capitalists and profit seekers. This is Rick Action Jackson, your growth stock guru. It is Wednesday, July 22nd, and Wednesday is when we comment, or I comment, on stocks that people have either texted or emailed me and asked me to give me I will give you my 2 cents. So we're going to kick off with Google, or Alphabet, G-O-O-G. First, let me state that this is not advice. I am not a licensed financial advisor. This is purely for educational purposes. If you find you have interest in any of the stocks discussed here today, please review with your financial advisor first if an investment in that stock is appropriate for your risk level, tolerance, and your goals. But Alphabet reports tonight after the close. It's probably going to be the most listened to conference call of this quarter's earnings season. What Google has successfully done that not everyone else investing heavily in AI has done is shown improvements in both their growth rate and their profit margins, and they have attributed those improvements to their AI investments. They've also been increasing their AI investments, informing Wall Street at least twice a year, if not every quarter, that they've expanded the budget for more CapEx to build more data centers. It'll be interesting to see tonight how the stock market reacts to all that. We had some very encouraging news this morning. Today was a profit-taking day in the stock market. Almost all the indexes are down. Many are just marginally down, but almost all of them are down. Most stocks are down. Good profit-taking session after a couple of up days. Oil's hit a 3-month high. Apparently, Iran's determination to not stop shooting at people is making people nervous. But I don't think oil is going to be a problem unless it gets above $120 a barrel. It is at a 3-month high of 95 in London, and it's flirting with 90 here in the U.S. Higher than it was for the last 2 months, but nothing that I think would cause a recession. I personally don't believe oil will get high enough to cause a recession, but that's just my opinion. We'll see. But Google tonight is going to report. I would say to anybody out there, if you don't own Google, I would buy some before the close today if it's an appropriate risk stock for you. I think Google is the ultimate high-tech company. They're in the lead on almost everything they do, and we need an entire show to go into everything they do. But the one thing that I sleep real easy upon is that they've only missed the earnings estimates twice or 3 times in 15 years. They almost always beat the earnings estimate. It's by how much that is the variable. And I would expect tonight they'll beat it, but not by a ton like last quarter, but certainly they'll beat it. And they've got this enormous reservoir of earnings. They own YouTube. They invest so heavily in YouTube that YouTube does not show a profit. It generates a lot of gross profit, but no net profit because they're constantly reinvesting in the platform. And they have not raised their advertising rates much, if at all, because they don't want to scare away small businesses from advertising on the platform. I actually went to their analyst day last year, and they talked about how they felt only 15% of the small businesses in America are properly utilizing internet and new media advertising to promote their businesses. And they're going to try to keep the rates level until they have at least 50% of the small businesses utilizing it. I can tell you from friends that have small businesses that have advertised on Facebook and Google, the results they've gotten are impressive. The ROI is very high. There's definitely room there for Google to raise rates when and if they want to, but they don't show any earnings on YouTube at all. They reinvest every dollar of profit into expanding the platform. And get this, YouTube has more hours of eyeballs watching it than the top 26 cable stations combined. and they now have more viewers and more members than Netflix. And you're getting that all for free. None of it's in the earnings estimates, and I don't believe any of it's in the valuation. But I think you're getting basically Netflix's number one competitor for free when you buy Google. I have no idea if the stock's going to go up or down after the earnings, but I would view if it went down as a buying opportunity to buy more. I think almost every portfolio should have at least a market weight, if not higher, on Google. And tonight's earnings are going to be interesting. So I did buy some more myself today. I think the earnings are going to be good, but we shall see. Often I've found Wall Street to sell off on a good earnings report just because of one silly comment made by the CEO to CFO that was blown out of proportion. So again, no idea if we're going up or down tomorrow after the earnings are reported. But if it does shoot up $10, $20 and you don't own it, I'd buy some here with the understanding that if it shoots down $20, $30, you want to buy more. Okay, and that was for Mindy in Salem, New York. Peter in North Conway, New Hampshire, wanted to know about a very interesting company that is trying to revolutionize the batteries that cars use, Quantumscape, QS. I picked this one because I just did a lot of work on this, and I'm deciding to pass on this stock. It's a very exciting story. They're trying to develop a battery that uses a lot less lithium and will be cheaper by a factor of 50% or more than the current electric car batteries out there and have longer periods in between charges. They have a strong alliance with Volkswagen, and Volkswagen invested in the company. Here's why I'm passing. A lot of competition here. A lot of competition. And Tesla and Apple also put a lot of R&D into batteries, and they both recently filed patents in the last 90 days on batteries that they're self-describing as revolutionary. Apple's going to start producing a battery within the next year that'll be in all their top-of-the-line phones. It'll let you go 5 to 7 days between charges. And Tesla's new battery, again, half the lithium than prior batteries. What people are starting to discover is that if you surround the lithium with copper and steel and twirl it, you get a lot more out of the lithium than if you just had a big block of lithium in the battery. And Tesla's new light lithium battery supposedly will let the car drive for 21 hours between charges. And they plan on putting this in all their robo-taxis, and they're going to start putting it into their top-of-the-line cars. So I doubt Tesla's going to buy from Quantumscape. And Volkswagen only has 7% of the global car battery market. 50% is dominated between Tesla and China's top electric car manufacturer. And China's going to buy their batteries from a Chinese company. So let's say Quantumscape gets their battery to do what they want it to do, and they get it mass produced. I just don't think they're going to get a lot of automobile companies to buy it. Now, they do currently supply all the batteries for Volkswagen's electric motorcycles, but that's a tiny market. And at the rate they're burning cash, this company could be out of business in 2 years unless they dilute themselves and sell some more stock. So we're going to pass on Quantumscape, Pete in North Conway. I would stay away from it. Our next stock is also a fairly speculative stock. It almost qualifies for my top quintile strategy. By the way, Google did qualify for all the check boxes on the top quintile strategy, which is what I use to pick stocks. This company is Aurora Innovation. Let's go to the chart. This company is at an interesting price based on its trading history, although I wish I had found this stock when it was under 5. At under 5, I'd be a lot more excited. This company does already generate about $1 per share in revenue, and they also have $1 per share in cash. And you see it spiked all the way up to 15 in the first month after their IPO, and then it just collapsed down to 5, and it's traded between 3 and 6 for the last 4 years. They are on a bit of a breakout here. What this company does is they design all the software and the systems to put a robo-driver in a long-haul tractor trailer. And they're already operating in about 100 trucks. They want to be in 500 trucks by the end of the year, and they want to be at 1,000 trucks within 18 months. There's 4 other companies trying to do this, and 2 other companies trying to do this ran out of cash and went out of business before they got a prototype to work. One of their competitors also has a prototype and also has trucks on the road using it. I'm not going to put this in my top quintile strategy, but if you're willing to give this stock 3 years and you're willing to buy more of it if it pulls back to the $5 level or $4 level, which is where the technical support is, understanding that it's speculative, which means you need to be prepared. You could lose 50% or more of your money in this. I think this has got decent chances of being a big payoff. The one hesitation I have on this stock is that it's well known that they are in the lead on this technology, and it is considered one of the no-brainers for robot technology and automated driving. But it's not that big of a market. Long-haul tractor trailers are only about 15% of the trucks on the road, although they are about 30% of the miles. And these companies are going to charge by the mile. Right now, this company's got a $15 billion market cap. To justify that, they should be generating at least $1 billion in revenue, and they're generating less than $100 million. So you're paying a big premium because you're on the horse with the best odds of winning this race. Okay, what do you win for the race? Let's go out 7 years. I don't think this market's going to be any bigger than 20 or 30 billion in revenue. And the company's own forecasts is that this is a $30 billion market, meaning they're charging 85 cents a mile. It costs trucking companies about $1.65 a mile to have a human being drive the truck. So at 85 cents a mile, you look at the amount of miles these trucks do in America, that's where you get 30 to 40 billion in revenue. If they could do 10 billion in revenue, then I could see the company being worth 30 to 50 billion in market cap. It's currently a $10 billion market cap with 100 million in revenue. If they get to 20 billion, then you got a home run. Then you got a 50 to 100 billion dollar market cap company. But I figured to do that, they would need at minimum 15,000 trucks. They're hoping to have 1,000 in 18 months. So if they perfectly execute their plan, it's probably a $30 to $40 stock in 5 to 7 years. If they experience delays, and these are prototypes, companies have delays in manufacturing prototypes. Just because it worked in the lab doesn't mean it's going to work on the factory floor. And there's a lot of regulation here. Right now, robotic trucks are only allowed on the road in Texas, Oklahoma, Arizona, and a half dozen of the Rocky Mountain states. Basically, the places in America where the road goes straight as an arrow for 100 miles and nobody lives there. I don't think the states that have high populations are going to welcome these trucks in very quickly. So between regulations and prototypes, I don't think they're going to get there without a hit, without any bumps. If this stock pulled back to $3 or $4, yeah, then I really like it because then it's fairly priced for where they are. But this is a high-growth market. It's a sexy market. So let's see. Matt in Scarsdale brought me this one. Matt, I wouldn't talk you out of it, but here is the way I would describe it. And I'm not cannibalizing here. Another analyst that I respect summed it up this way. If they perfectly execute their plan as they want to, and there are 10 billion in revenues in 5 to 7 years, he gives that a 35% chance of happening, but it will be a home run stock. stock will easily be at least $30, if not $50 in 5 to 7 years. That'd be an annual return of 22 to 35%. He said there's a 55% chance that there are delays and the stock just bounces around between $4 and $10 for the next 2 years before this company is actually able to generate $1 billion in revenue and justify a significantly higher value. And he gives it a 10% chance they run out of cash and go bankrupt. They are burning $100 million a quarter. They will be out of cash by the second quarter of 2028 if they do not ramp up sales and start generating enough revenue to break even. I agree that it's probably a 10% or less chance that happens, but this is not my favorite. It's not going to go on my buy list. But when I weigh the upside potential versus the downside risk, it's interesting. And like I said, if it fell down to 5 or less, I'd get a lot more excited. But here at the 650, Matt and Scarsdale, I wouldn't talk you out of it as long as you understand this is speculative, no tears if you lose a lot of money on this. But this company does seem to be the one to beat in this niche, and this niche will be a significant business probably within 10 years, but maybe as little as 5. So AUR, be aware. High risk, but it could be high reward. Next one we have Dell Computer, which I've commented on before, but I came back to it because a lot of people are asking about it. This particular request was from Don and Trumbull. Don bought the stock at a similar time to when I did back in 2025. He's up 300%, and he was wondering if he should sell it here. The stock is up $37 today because SMCI, Semi-Micro Computer, released an incredible piece of news today. They took in the second quarter $60 billion in orders. This company does about $10 billion a quarter in revenue. So that stock's up 6 points today, or about 20%, and Dell's up 37%. My target on Dell is $772, which gives you 60% more upside over the next 2 years. But let's go to the chart. When you see a chart that is spiked up like this, there's a lot of people here that have made a lot of money quickly. And any bad news at all is going to cause a trigger finger to hit the sell button on this to lock in the profits. This stock's going to have a tough time getting much higher in the short term. I think it will get to 700 within a year or two. I wouldn't be surprised to see it fall back to 300 in between there. I would get more excited about buying this closer to 300 than here at 440. What I would do is I would sell Dell and I would buy SMCI. I was pushing SMCI on a podcast 3 weeks ago at 27. It's at 32 today. Let's bring that chart up. Why would I do that? Well, I got a target on SMCI of 82. So Supermicro has over 200% upside, and Dell's got 60. They're both riding the same wave. These guys build the servers that run the data centers. And the reason their business is exploding is data center business is exploding. So I have nothing bad to say about Dell. I just think on a risk-reward basis, you'd be better off taking the money here and swapping it into Supermicro. Supermicro is probably just at the beginning of a big run. And when I talked about it a few weeks ago, the reason I liked it was that they had done an offering, which did dilute the stock, but it's behind us. And now they've got $6 billion in cash on the balance sheet. They're going to double their production capabilities with that. And they brought in a whole new team of management. The prior team of management missed some earnings forecasts. They got caught booking revenue that had not been invoiced to the client yet. And 2 of them actually got caught trying to smuggle their servers into China. And one of them was actually caught at an airport in Singapore with $2 million cash in their briefcase. All of them are gone. And what kills me is that this company with a bunch of clowns running it still keeps getting orders, which tells me they've got a device no one else can make. So let's swap Dell for Supermicro. And again, nothing bad about Dell. I just think Supermicro is a better way to play this, much better risk reward. I think Supermicro's got at most $6 a downside, which is about 20%. I think Dell's got $150 a downside, which is 33. but Supermicro's got 200% upside and Dell's got 50. So let's do that. All right, moving on to our final one for the day, Applovin. I'm revisiting this. Danny in City Island said to me he bought it when I talked about it, and now it's down $30, $40 from when I first talked about it. What do we do now? Let's look at the chart. This company's business is exploding. There's a rumor going around that they've been cooking the books. I've looked at the books hard. I've looked at the argument the short sellers made on it. I don't believe it. And the company announced, since the stock broke 450, that they're going to accelerate their repurchasing of the stock. And they've got a lot of cash. So, hey, they're shrinking the float. They are exploding in revenue. And what Applovin does is Applovin is kind of the YouTube of the video game world. And AI has caused an explosion in their business because with AI, it's a lot easier to create a video game. But when you create a video game, you don't make any money unless you get people to buy it and play it. So the video game creators create ads on Applovin because that's where all the video game players go, and that's where they broadcast enticements to get you to try their new video game. So with Applovin, I will buy more of it here. My rule on a stock that is down more than 10% from where we bought it is that if there's any reason whatsoever that you don't like the stock as much as the day we bought it, then sell it. And my thinking is that it's really easy to make back a 10% loss. But if the stock goes down 25%, then you got to make a 33% gain on that cash. And that's not easy. And if the stock goes down 50%, you've got to make a 100% gain on that cash to make your money back. And 100% is really hard. I mean, we have them, but that's not the norm. It's usually 1 out of 10, 2 out of 10 go up 100% a year in a really hot bull market. So if I didn't like Applovin more today than when I first talked about it, I'd be selling it here. However, the board's confidence that there's no real accounting issues and their increasing of buying back the stock makes me like the stock even more, and it's cheaper. So I would hang in there, Danny, and if it's appropriate on a risk level and if it's appropriate on the amount of cash I have available, I would buy more. And I do plan on buying more of this stock tomorrow. Okay, that's it for today, folks. Thanks for joining. Again, send us your stock tickers that you'd like me to comment on, putting it through the Total Quintile filter. Catch you on the rebound.